All right, let's just dive right into this. Welcome to today's Explainer. We're looking way past the surface-level NVIDIA hype today to uncover what I call the invisible architectural war controlling the 2026 semiconductor supercycle. You've probably seen the headlines, you've definitely seen the massive market moves, but the real story, the actual foundation of all this artificial intelligence, is happening underneath the silicon surface. Today, we're going to explore why owning the chips might just not be enough if you don't actually understand who owns the underlying architecture.
So, here's the game plan for today. We're going to look at the April 2026 SOC surge, the invisible architectural war, ARM as the AI gatekeeper, AMD defending x86, Lattice as the edge AI sleeper, and finally, the brutal truth on valuations.
Okay, Section 1, the April 2026 SOX surge. This is really just the tip of the iceberg.
Now, we have to start with a massive reality check. The SOX index, the Philadelphia Semiconductor Index, just pulled off this insane 18-day winning streak. We're talking a massive 40% return in just the month of April 2026 alone. Everyone is talking about memflation. These huge spikes in memory prices making top-line revenues explode. But here is the multi-million-dollar question. While retail investors are out there chasing momentum, inflating these top-line figures by buying up chip manufacturers, are they actually buying the true gatekeepers of the ecosystem? Basically, you're buying the chips, sure, but do you actually own the architecture?
Just look at this macro setup. The current deviation of the SOX index from its long-term 200-day moving average is completely off the charts. Literally. We haven't seen a technical disconnect this extreme since the absolute peak of the dot-com bubble back in June 2000. It's wild. What this tells us is that we're not just looking at a fundamentals-driven AI rally anymore, it's a liquidity-driven chase. And guess what? The really sophisticated money, the smart capital, they're seeing this too. They're quietly rotating out of the obvious capacity builders and moving right into the architectural gatekeepers.
Which brings us to Section 2, the invisible architectural war, RISC versus CISC.
To really find the alpha here, we've got to look below the surface at something engineers call the dark silicon problem. Basically, data centers physically cannot power and cool all their chip transistors at the same time anymore. If we plugged it all in at once, we'd literally melt the grid. Seriously. So you've got x86 architecture, your Intel and AMD, which is a complex instruction set computing model, or CISC. It is bogged down with massive legacy bloat and variable length instructions. Think of it like trying to read a giant paragraph where every word is a totally different length and someone removed all the spaces. Your brain has to work incredibly hard just to decode it. That burns so much heat and power. But then you have ARM. ARM uses RISC, or reduced instruction set computing. It uses fixed-length instructions and predictable decoders so the system never has to guess. Plus, ARM moved on to much larger memory page sizes, like 16K and 64K, while x86 is still dragging around these ancient Forte pages like a heavy suitcase it just refuses to unpack. The result? ARM consumes 20 to 40% less energy for the exact same workloads. And at data center scale, that is millions of dollars in electricity and cooling saved. Period.
All right, Section 3, ARM, the AI gatekeeper, or as I like to call them, the ultimate toll booth.
So because of that massive efficiency gap, ARM has basically evolved into the ultimate toll booth of this 2026 AI cycle. Their business model just brilliantly builds upon itself. First, you've got the upfront licensing model. You pay a fee just to use their designs. Simple enough, right? But second, as these hyperscalers migrate to the newer ARM v9 architecture to get better AI performance, ARM gets this massive royalty rate inflection. The royalties on v9 are effectively double the previous generation. Double! And third, they rolled out these compute subsystems, or CSS. Now, instead of just selling you blueprints for a single core, they sell you a fully integrated subsystem. It saves customers years of development time, but for ARM, it acts as a massive revenue multiplier because they're capturing way more of the system's total value. It is essentially a 94% gross margin money machine.
And if you really want to grasp how big their ambition is, just look at this number. $15 billion. That's the annual revenue ARM is targeting right now with their disruptive move into actual production silicon. With their new AGI CPU designed specifically for AI inference in data centers, ARM isn't just selling blueprints anymore. They're going from being a pure collaborator to, honestly, a frenemy. They are aiming straight at that massive, power-hungry inference market, making absolutely sure they collect their toll, whether they design the chip for someone else or just build the whole thing themselves.
Now moving on to Section 4, AMD, the x86 Defender, and why they are priced for perfection.
The incumbents definitely aren't just sitting around. AMD is the main defender of the x86 legacy right now, and they're actively forming alliances to strip away all that old 16-bit and 32-bit bloat we talked about. But behind the scenes, AMD is fighting tooth and nail for market share using some super complex financing arrangements. We're seeing this circular financing loop happening all across the AI space. It kind of works like this. A chip designer, let's say AMD, might give stock warrants to a huge AI startup like OpenAI in exchange for a solid commitment to buy AMD's Instinct chips. So venture capital flows into the startup uses that cash to buy chips from the manufacturer, which pumps up the manufacturer's stock price, which then makes those initial warrants incredibly valuable. It completely props up short-term demand. But it definitely leaves us wondering, is this actually organic end-user demand, or is it just a really, really expensive merry-go-round?
And that leaves AMD caught between a rock and a hard place. The reality is their Q1 FY 2026 numbers are rock solid. They posted 34% overall revenue growth and a whopping 39% growth in their data center segment. They are executing, no doubt about it. But the vulnerability here is the market's reaction. Retail investors went crazy chasing this momentum, and it triggered a 70% stock surge in literally 30 days. When a stock skyrockets like that based on sky-high AI expectations and those circular financing loops, the valuation becomes dangerously priced for absolute perfection. Think about it. If the supply chain stumbles even a little bit, or if one major hyperscaler delays the data center rollout by just a few months, that illusion of perfection completely shatters.
Okay, let's shift gears to Section 5, Lattice, the edge AI sleeper, operating on the far edge. While everyone is totally distracted watching AMD and ARM duke it out, there is a total sleeper pick hanging out on the far edge of the network, and that's Lattice Semiconductor. They are the last pure-play stock in an incredibly vital niche. To get why they matter, you have to know what an FPGA is, a field programmable gate array. Unlike a CPU or GPU that runs lines of software code one after another, an FPGA is basically a blank canvas of reconfigurable silicon fabric. It literally runs hardware, not code. You program the physical logic gates themselves. This gives it absolute deterministic low latency for real-time sensor processing. We're talking about a robotic arm catching a fast-moving ball or an autonomous car slamming the brakes the exact millisecond it spots an obstacle. Think of FPGAs as the ultra-fast, low-power support team doing rapid prototyping and sensor fusion, which critically frees up the high-power GPU MVPs back at the data center to do the heavy lifting.
And this is where the whole puzzle pieces together into the tri-layered hybrid pipeline. Modern AI, especially physical AI like robotics, absolutely requires all three of these architectures working together seamlessly, which, by the way, is incredibly hard to do. First, you got the FPGA acting as the data plane, processing pixel and radar data the exact millisecond it arrives. Second, you have ARM acting as the control plane, managing stable telemetry and booting up the system with crazy good power efficiency. And finally, x86 steps in as the orchestration plane, handling all the high-level, complex software logic. Nailing this tri-layer integration, that is the ultimate competitive advantage for the future of edge AI. You can't just own one piece of the puzzle. You have to know how they all talk to each other.
Which brings us to our final part, Section 6, the brutal truth on valuations and multiple compression.
I really want you to let this number sink in. 128x. That staggering figure represents AMD's peak forward price-to-earnings ratio during that massive early 2026 surge. Listen, when you buy in after a monster surge like that, you aren't just betting that the company is going to grow. You are betting that it's going to grow significantly faster than the already astronomical expectations baked into a 128x multiple. Basically, you're offering to pay for 128 years of a company's current earnings right up front, just praying that their growth rate never so much as hiccups. It's wild.
When valuations get this stretched out, the math just gets terrifying. Look at the metrics from May 2026. You had ARM holdings stretched anywhere between 109 and 260 times earnings, AMD pushing 128x, Lattice sitting at about 84 times free cash flow, and ironically, NVIDIA, the one everyone was hyping up, was sitting down at a relatively calm 22x. The brutal truth here is that in a liquidity-driven market, a good earnings report just doesn't cut it anymore. If a company trading at 200 times earnings reports a standard beat, institutional managers see that as a deceleration. That's exactly why we've seen stocks in this sector completely crater, dropping 15% in a single session right after reporting what looked like great earnings. It is a classic sell the news trap, and the multiple compression that follows can literally wipe out years of returns in a matter of hours. As we've unpacked today, the invisible supply chain is where the next decade of alpha will be found. This sector is rapidly transitioning from a straightforward AI bull market into a really complex valuation reset. The real alpha, the actual edge that the smart money has, comes from understanding these underlying architectural shifts. You've got to know exactly why ARM's power efficiency is taking over, why AMD has to execute flawlessly to justify its multiple, and why Lattice's FPGAs are the crucial connective tissue for physical AI. It goes way, way beyond surface-level chip hype.
So, as we stare down the extreme volatility of the supercycle, ask yourself a hard question about your own portfolio. Are you just blindly investing in the fleeting chip hype and chasing whatever's trending, or are you actually positioned to own the foundational architecture of the future? Think about it. Thanks so much for hanging out with me on this explainer. Keep learning, stay curious, and I'll see you in the next one.